Hello everybody, welcome to Management Accounting. Let's get started. There are four types of accounting. The first that many of you might be familiar with is financial accounting. The second is management accounting. The third is cost accounting. And finally, we have tax accounting. We will discuss each one of them in a little bit of detail. Financial accounting is designed to help people outside the company make decisions. These outsiders may be creditors of the company, they might be suppliers, they might be investors. Investors are people who currently invest or are potentially interested in investing in this company. There might be government agencies like IRS who want to determine the company's tax liability, and so on. The purpose of financial accounting is to present a fair picture of the financial condition of the company. Financial accounting produces the following reports of the company that I'm sure you are familiar with. Income statement tells us how much money the company made or lost in the previous year. The balance sheet is a statement of positions that tells you how much assets and liabilities a company has. Statement of cash flow tells us about the cash position of the company, where the cash came from, where it went, what is the current cash position of the company, and finally we have statement of owner's equity that tells us about the changes that happen in the owner's equity due to increase or decrease in earnings, issue of dividends, new shares, etc. Financial statements are followed. Financial statements must comply with GAAP. GAAP is generally accepted accounting principles and must be verified by a CPA, popularly called an auditor, who testifies that GAAP rules are being followed. Financial accounting statements are produced quarterly or annually, and they report on the financial condition of the company. Let's go to managerial accounting. Managerial accounting helps people inside the business take decisions. These internal users may be top executives, they may be managers, production and sales people of a company. The job of management accounting is to provide whatever information is necessary to make the best decisions for the company. For example, CEO of Kellogg, a large cereal company, may be interested in knowing if his UK office is making more money than his France office. A manager of the same company may be interested in finding out which of his 4 brands of cereal is most or least profitable. The production manager might be interested in knowing how much it costs to make 1 box of cereal, or a marketing manager may want to know if $1 million advertisement on Super Bowl will increase overall company sales and profits. As I said before, since the main idea of management accounting is to help managers make decisions, its focus is different from financial accounting. Mainly, there are no rules to be followed since reports are meant only for internal use. Then, reports are generated more often, many times daily, weekly, or monthly, and are usually broken down by the product line and geography. Let us briefly review the differences between financial and managerial accounting. Firstly, financial accounting is meant primarily for external users such as creditors, investors, government, etc. Managerial accounting is mainly used by internal users such as managers, CEO, and employees of the company. Time focus of financial accounting is typically on the past transactions. For example, the reports of 2010 performance will be prepared in 2011. In managerial accounting, the orientation is more towards the future. For example, budget for 2011 would be prepared in 2010. Thirdly, financial accounting includes only verifiable information. Those can be supported with receipts and documents, etc. Managerial accounting, on the other hand, focuses only on relevant information. In financial accounting, the focus is on precision, but in managerial accounting, the focus is on timeliness. Good estimates will do as long as they are available quickly. Financial accounting is mandatory. There is no such compulsion for managerial accounting. Then we have GAAP. Financial accounting has to conform to generally accepted accounting principles. Managerial accounting is not bound by any rules. Finally, they differ on the type of reports they produce. Financial accounting produces annual or quarterly reports generally for the company as a whole. In managerial accounting, time span varies with reports on segments such as product lines, sales territories, or different divisions. Let's look at cost accounting. Cost accounting helps managers make better decisions. It provides information for both managerial accounting and financial accounting. It measures and reports both financial and non-financial information relating to the cost of using resources in a company. For example, cost accounting may provide per unit cost of different products in a company. It may also provide information on performance of a particular department of the company, or it may provide information on the cost of servicing foreign customers, etc. The information generated by cost accounting can be used by financial accounting, for example, in calculating the cost of ending inventory, or by management accounting in deciding which products to produce internally and which ones to outsource. In reality, most cost accounting information is collected for the purpose of managerial decision making. Hence, the difference between management accounting and cost accounting is very little, and the two terms are often used interchangeably. Let's briefly look at tax accounting. To a layman, accounting often means tax accounting. Tax accounting helps us determine the amount of taxes owed. Rules regarding tax accounting are decided by Internal Revenue Services. Contrary to popular belief, taxes are only a small part of accounting. Let's practice. Which of the following groups would be least likely to receive detailed management accounting reports? This question says which of the following parties or groups are least likely to use management accounting. Let's see. Stockholders, which is the same thing as shareholders, are least likely to receive detailed management accounting reports because stockholders are outsiders. Sales representatives, production supervisors, and managers are all internal people who are likely to receive detailed management accounting reports. Let's look at one. Management accounting includes all of the following except. So we have to figure out what management accounting does not include. Let's see. Management accounting includes implementing strategies, it includes developing budgets, it includes preparing special studies and forecasts. What it does not include is preparing the statement of cash flow. Remember, statement of cash flow is prepared under financial accounting and is not included in management accounting. Let's talk strategy. Strategy of a company tells us how it chooses to compete and be successful. Businesses usually follow one of the two broad strategies. One is considered to be a low price strategy, which means offering a reasonable quality product at a low price. Costco and Walmart are examples of businesses which follow a low price strategy. The second is a product differentiation strategy, which means offering a unique product or service priced higher than the competition. iPads by Apple is a good example of this strategy. In choosing a strategy, a company must consider its strengths, its priorities, and its customers, its competitors, its resources, as well as the sensitivity of its product to price, quality, and service. Management accounting helps managers choose a strategy to communicate it to the rest of the company and then to implement it. Let us learn how to pick a strategy for any company. Suppose you want to open a new pizza store in your town. Suppose you can't afford a fancy location in a mall and would have to settle for a location in the residential area. What should be your best strategy? A low price one or a gourmet quality, high price one? Well, Given the location, your customers are likely to be local people on a tight budget, so a low price strategy would be better. But if you have an exceptional cook or a lot of money to advertise and you can rent in a fancy high-end mall, you might want to go for high price but exclusive customer type of strategy. The question here is, what makes a company successful? It can be one or more of the following edges that a company may have. One is cost and efficiency. As I said before, low cost can help a company profitable for a long time and in competition. Second is quality. A company's reputation to make high quality goods or deliver high quality services can help it attract and retain customers. Total quality management, also called TQM, is a strategy in which companies improve operations throughout the company to provide quality goods exceeding customer expectation. Timeliness can also help a company be successful in many ways. It may be the time taken to develop a new product or drug before everyone else, or it may be the speed at which the company responds to customer demands, or it may be just quick delivery of products. For example, FedEx's overnight delivery and Netflix's online streaming made these companies extremely popular. The next key success factor is innovation. Some companies make significant investment in research and development to keep a constant flow of innovative products and services. For example, Apple is a relatively young company, but it is the most expensive stock in the market today. Value chain is the sequence of major business functions that add value to products or services. A typical value chain is a sequential series of business functions. At each stage, some value is added to the product. The first step in any business is to decide what you want to sell and how would it be better or cheaper than other products available so that the customers might buy it. So if you want to open a pizza store, for example, you might want to add value by coming up with a tasty or different kind of pizza with less fat or less salt, etc. The second step involves designing and engineering of products. For example, in your pizza store, you may experiment with whole wheat or mixed grain flour or try different toppings to come up with the best combination. The third step involves putting together raw materials, labor, and other resources necessary to start production or delivering a service. For example, lining up reliable suppliers or hiring a famous chef will add value to your pizza at this stage. Marketing involves communicating information about your product and making efforts to sell it. For example, creating creative pamphlets might be cheaper and more effective for a pizza store than an expensive television ad. Distribution involves delivering the product to customers. For example, fast delivery for phone orders or courteous and clean in-store environment will add value to your pizza. Customer service involves providing after-sale service, providing repairs under warranty, or providing help on phone or internet. For example, your pizza store may benefit from adapting the policy of hot or free, or fast or free, or providing small questionnaire on paper table mats to get some feedback from its customers. Value chain helps a company focus on what it does best. For example, Apple's focus on R&D to come up with innovative products or Sony's focus on designing smaller and sleeker devices are both successful. Another benefit of understanding value chain is that the companies can outsource. Now let's look at a supply chain. A supply chain describes the flow of goods and services from the stage of purchasing raw material to the delivery of products to customers. You will see more detailed information on supply chains in other business school courses. Let us be clear about the difference between a value chain and supply chain. Value chain is a series of activities or functions that add value to business. Supply chain, on the other hand, is a series of people or companies that ensure smooth running of business. Sorry about that. Let us talk briefly about what managers do and how they translate company strategy into action. Planning simply means thinking ahead. Managers have to constantly plan ahead to keep costs down and profits up. The first step in planning is to pick a goal to be achieved. The second is to identify all the alternative courses of action available and then choose the best alternative. The next step is to obtain the necessary information and analyze it. A budget is a useful tool in planning. A budget is essentially a quantitative expression of a plan. It helps all other employees of the company understand what top management wants to achieve. Also, budgets are useful in comparing actual performance to the goals and identify the mistakes or problem areas and hope to improve future performance. This comparison of actual numbers to budgets is called the control function of management. Control function basically makes sure that the plan is followed. Control function essentially uses feedback, which is the key to effective control. Managers compare plans with their actual execution and identify problem areas that would require attention. Feedback provided by performance reports is also used to measure employee performance and becomes a basis for decisions regarding promotions, bonus, and salary increases. So, planning via budgets makes quantifying of goals possible in any company, and controlling via feedback makes motivating company employees possible. Let us look at this problem. Strategy is formulated by answering all of the following questions except who are our most important customers? We look at this question carefully. Is industry demand growing or shrinking? Will our external auditor certify our strategy? And how sensitive are purchasers to price, quality, and service? What do you think? The only thing that looks like an odd man out here is C, which says, will our external auditor certify our strategy? External auditors are supposed to certify your financial statements, not your strategy. So, since the question is asking except, which means you have to choose one which is not related to formulation of strategy, so C should be our answer. Let's look at one more. Place the four business functions in the order they appear along the value chain. If you remember the value chain, it starts with research and development of a product and goes all the way to customer service. So see what you would be able to do with the things. Clearly, you'll have to design the product before you make it. So design should be one, production should be second, and then marketing, and then customer service. So you can figure out that option C, which goes in the order design, production, marketing, and customer service, should be your right choice. One more. You are supposed to pick what describes the flow of goods, services, and information from the initial sources of materials and services all the way to the delivery, regardless of whether those activities occur in the same organization or in other organization. Think about it. It's saying describes the flow of goods and services and information. So, could it be the value chain or could it be the supply chain? Remember, the value chain is a series of functions that add value at each step. Supply chain describes the flow of goods, services, and information from the start to the end. So the correct answer here should be B. When you hear about an accounting scandal in a big company like Enron, WorldCom, or Arthur Andersen, a natural question to ask is if managers or auditors were doing their job honestly or not. Since insiders of a company like managers and auditors and accountants often know most about the company, there is a natural temptation to twist or reinterpret the accounting results for personal or corporate benefits, even if it hurts the shareholders, the consumers, or the environment. In order to govern the behavior of insiders, many professional bodies such as Institute of Management Accountants and Security Exchange Commission, also called SEC, impose tough ethical standards and improve on them from time to time. IMA, Institute of Management Accountant, uses 4 pillars of ethical conduct to guide managerial behavior. One is called competence. Competence means that managers should be up to date with relevant laws, regulations, and other developments in their field. Second, confidentiality. Confidentiality dictates that managers not disclose companies' information to anyone for personal or illegal advantage. So, talking to your girlfriend or wife or a competitor or a media person about a company secret can be a violation of confidentiality. The third is integrity. Integrity requires managers to avoid conflicts of interest and refrain from unethical behavior. For example, accepting gifts from suppliers or clients or not reporting on your boss or friend in the company if they are engaging in unethical behavior can all be violation of integrity. Finally, credibility. Credibility demands that managers disclose important information fairly and objectively, even if the information is potentially damaging to them personally or to the company. Most companies have procedures in place for dealing with ethical violations. Typically, it requires going to your immediate boss first or to the next level manager, especially if the matter concerns your immediate boss. As a next step, you can approach an attorney or an IMA authority to know what your rights and responsibilities are. As a final recourse, you may choose to resign if you feel that the culture of the company or the department is to ignore or reward unethical or possibly illegal behavior. Remember, if you know or did something wrong and did not speak up, you will also be a guilty party whenever the cat is out of the bag. Here, we have listed some of the ways that companies try to resolve their conflicts. So, in most cases, it is quite subjective because you have to follow the established policies of the organization. As I said, you can discuss problems with your manager, you can discuss problems with higher level authorities, try not to go to the press as much as possible, and if all else fails, then resign. Let's look at one last problem before we go. Ethical challenges for management accountants include whether to accept gifts, knowing it is an effort to influence decisions. Yes, it is unethical behavior. Second, whether to report unfavorable department information. Obviously, this is unethical behavior too. Whether to file a tax return this year is not a part of ethical challenge. Both A and B are correct is the correct answer. So our answer here is D. Portion C, which says whether to file a tax return this year, is completely a financial responsibility, not an ethical challenge. I'm sorry, this was supposed to say end of the chapter, but it didn't come out. Thank you for listening.